Let me tell you something that surprises almost every international investor I speak to about Dubai. You can buy a $1 million apartment here and only pay $200,000 upfront. That's not a gimmick. That's not a developer struggling to sell. That's the standard structure of off-plan property in Dubai. And once you understand how it actually works, the mechanics, the protections, what to look for and what to avoid, it completely changes how you think about investing here. So today, I'm going to walk you through everything: how payment plans work, why they exist, what makes a good one, and the questions you should always ask before you sign anything. Off-plan simply means you're buying a property before it's built. The developer needs financing to construct it, and instead of going purely to the bank, they raise money directly from the buyers, like you. In exchange for buying early, you get two major advantages. First, the price. Off-plan prices are almost lower than the complete market value of the same unit. You're being rewarded for the risk of buying something that doesn't physically exist yet. Second, the payment plan. Instead of paying the full amount upfront, you pay in stages. A percentage on booking, a percentage during construction, and the remainder on handover, or sometimes even after. The structure is what makes Dubai genuinely accessible for international investors. You're not tying up $1 million in one go. You're managing your capital in tranches, often over 2, 3, even 4 years. Let me give you a concrete example. A typical off-plan deal in Dubai right now might look like this: 20% on booking. That secures the unit and locks in your price. Then another 40% paid in stages during construction, usually tied to completion milestones. So the developer hits a certain floor, you pay the next installment, then the final 40% on handover when you receive the keys. Some developers are offering even more attractive structures right now: 60-40 post handover, meaning you pay 60% over the build period and 40% after you've already received the property. In some cases, you're already earning rental income while you're still paying off the purchase. That's an extraordinary structure for an investor. And this is why uncertainty in the market actually creates opportunity. When developers want to move units, these plans become more flexible. I'm seeing things right now that I haven't seen in 2 or 3 years. Not all payment plans are created equal. Here's what I look at when I'm evaluating one for a client. First, the developer's track record. A payment plan is only as good as the developer behind it. If they've delivered projects on time before, the plan is meaningful. If they have a history of delays, those milestones shift, and so does your cash flow. Always check delivery history before you commit. Second, RERA registration. In Dubai, off-plan projects must be registered with the Real Estate Regulatory Authority. The funds you pay go into an escrow account that is ring-fenced for that specific project. This is a genuine protection that doesn't exist in many other markets. Verify the project is registered before you pay a single dirham. Third, what happens at handover? Some investors get caught out here. They've managed the construction payments comfortably, then the handover payment hits and it's 40% at once. Make sure you plan for that number, or look for post-handover structures if you need more breathing room. And fourth, look at the payment schedule relative to your own cash flow. A plan that suits one investor doesn't suit another. Think about when your capital is available, not just what sounds good on paper. I'll be honest with you, I've seen investors make the same mistakes repeatedly, so let me save you the pain. Mistake 1, buying purely on the payment plan without checking the location. Flexible plan on a badly located unit is still a bad investment. The plan makes it more accessible, it doesn't make it smarter. Mistake 2, not understanding the service charge. Once you receive the property, you'll pay an annual service charge for maintenance and building management. This varies significantly by development, and it eats into your yield if you haven't factored it in. Always ask for the projected service charge before you sign. Mistake 3, ignoring the exit. Off-plan investors sometimes get so focused on the entry that they don't think about when and how they'll exit. Can you sell during the build period? What are the resale conditions? These questions matter, and a good agent should be answering them before you ask. Off-plan payment plans are genuinely one of the most powerful tools available to an international property investor. When you understand how to use them correctly, the right developer, the right structure, the right location, they give you access to returns that are very difficult to find anywhere else in the world right now. If you have a question about specific projects or a payment plan you're looking at, drop it in the comments, and I'll give you my honest take.